This will be a daily outlook going into Tuesday, July 21st. Alright, I was unable to make an outlook yesterday, but I'll spend a bit of time covering by simply reminding yourself of the big picture here from a daily chart perspective. As we know, from a 3-month look back perspective, the market comes from expansion to consolidation. And essentially for me at this point, the question that I'm trying to answer is, will the market go for a new all-time high from 25% right of this range of the 3-month look back, or will it need to come lower towards say 50% of this range before trading higher? We still have here this weekly inefficiency, which is important as covered into previous outlooks. This inefficiency is located at 25% here of the current the current dealing range from the perspective of a 3-month look back. And you know, so far the market is holding these levels still, right? Is holding the range of the fair value gap located at 25% of this dealing range. But you can see that now it is building bearish order flow, right? Or at least is unable to, for the moment, right? Is unable to inverse, say, bearish PD rates that are located inside of this range, or to create new ones. Okay, so this level here, this weekly fair value gap, is definitely still an important level. I don't believe that the market should come back towards discount prices unless we were to see here a displacement, a strong closure below 50% of its level, right? This was the same thing that we had analyzed for here, the discount order block located inside of the previous monthly range. In fact, you can see that we're saying how when 50% of this level is closed, then we can anticipate lower prices. But as long as it's not closed, right, such as, you know, all these levels right here, that the market could use this level here to distribute back higher. Now, it failed to distribute back higher, right? The order flow here is bearish, and in fact, you can see that this level is now being used as a bearish mitigation block here, right? We have a high, a low, failure to make a higher high, and then a lower low. Right, and right, well, today in terms of a day, but yesterday in terms of a trading day, right, it has created a high of day at 50%. Right? This is a rejection at these levels. So this bullish order block here, in my opinion, is still an important PUA, especially from an intraday perspective. Important to see how price trades around the quadrants of it. I mean, just out of curiosity, right? You can see from a lower time frame perspective how the market uses these quadrants, right, to reaccumulate. Obviously, all depending on the side of the curve that you're trading. But what I'm saying is that this order block is obviously still valid to the range and does offer trading opportunities. Now, from a lower time frame perspective, say maybe on like a 15-minute chart or a 1-hour chart, a displacement back above 50% here of this, what is now for me a bearish mitigation block, right? But a displacement back above 50% of this, to me, I would consider this a reclaimed bullish order block. Okay, so I do think that it is important to keep this level in mind, but at the moment, this not right, as price traded below it, right, and it is now trading back inside the range of this weekly fair value gap. I am more interested now to see how price will trade at 50% of this fair value gap, right, and the reaction around it. And if the market were to trade below this level, then that would mean that would prove to us that the market is failing to expand from 25%, and so we'll likely seek to come back towards say 50% of this range, where we have the range of, we have here monthly inefficiency, and we have also the previous yearly high here. okay, which could be used inside of this inefficiency as a monthly bullish mitigation block. Okay, so for the moment, right, I'll just be marking out the low here of the month of May, right, as this is the candle that forms here the monthly fair value gap. But I won't be putting up the quadrants necessarily of this monthly fair value gap until I were to see a displacement strong closure below 50% of the weekly inefficiency. Okay, so these are discounted levels here, which are going to be important for bias, drawn liquidity, the weekly profile. In terms of a premium level, I mean, you know, you got here the range of a fair value gap, you got the range here of a bearish order block. But in terms of okay, so I mean, I guess, well, the thing is, the reason why I don't want to mark these out, right, as premium levels, is because it essentially comes from a consolidation here, right? And personally, I assume that it's only a matter of time before the market trades higher. Now, could it do it from here? Sure, right? Say tomorrow does something like this, starts trading higher. It is a possibility. And so, you know, there's just too many PD rays to choose from here in premium, in my opinion. And so what I would rather use, or at least, right, pay attention to, is to see, for example, this order block to become reclaimed. Right, because if the market were to displace back above, right, or at least close, right, on a lower time frame perspective, displace above 50% here of this order block, well, you know, the fact that it would do it after price comes from a shakeout at the previous monthly low, right, to me that would favor a continuation higher, right, of the overall trend here. Okay, so again, I won't necessarily be marking out in terms of premium arrays, say this bearish order block or this rejection block or this fair value gap. Obviously you could, but again, overall I'm more interested in seeing how price will trade around the discount order block from the previous monthly range now that it has swept the range low. Okay, so I'm going to be putting back this level. So the weekly fair value gap is my discount level. If price were to trade below this level, you could be targeting the high of the monthly fair value gap located at 27,800. Right, and then if, again, still this week the market were to trade past this level, then I would be looking at, say, 25, 50% here of the monthly fair value gap. Right, and overall to be aligned with the previous yearly high here, which, as we saw on the monthly, is a bullish mitigation block. Okay, so for the moment, in my opinion here, the order flow on the daily remains bearish, but you know, I'm being careful about having a bearish bias. Now, I obviously, you know, it definitely is possible here that I'm wrong and then the market does this. But I'm following a logic right here, logic being expansion to consolidation. And you know, now that the market is trading more into discounted levels, it has traded below the previous monthly range, and it has left behind here a large rejection block at 50% of the previous monthly, at 50% of the weekly fair value gap. You know, I just feel like, you know, and also the monthly, the quarter, having no business, right? There was never any business done above the opening price. To me, this looks suspicious here, right? To me, this tells that it's only a matter of time before price trades higher. But from an intraday perspective, or as a day trader, I can't hold that bias going inside of a session. Okay, so again, order flow remains bearish until invalidated. What would invalidate that, in my opinion, the bullish order block from the previous month becoming reclaimed, this can be enough for me to see price trade back higher towards, you know, if not all-time highs, at least the monthly, the quarterly open. And in terms of discount levels, I'm interested in these levels, right? To me, again, a displacement, a closure below 50% of this weekly fair value gap from a daily perspective, to me would mean that the market is looking for further discounted prices, and so we analyze that below 25% here. At 50% we have the range of a monthly bullish fair value gap. Okay, so that would be the drawn liquidity in that case. Alright, we can look here at the 3-week look back. Alright, so let's analyze what's inside of the range. At the highs here, we have an intermediate term high, right? If we look at 75%, we have the range overall of relative equal highs. Okay, so to me, what this means here, this PD ray look at, right, all these relative equal highs located at 75%. To me, this is only useful as a drawn liquidity. Okay, I'm not anticipating, say, for price to do this and then do this, right, to reverse from there. To me, this level is useful in case price were to find rejection at the low, so then trade higher. This would be the low-hanging fruit. Okay, you got relative equal highs, you got the previous weekly high, and all here, and these relative equal highs here form from this bearish order block. Okay, so this is the level that I want to have identified. Now at 50% of the range, this is where the range is high resistance, right? Price spent the most amount of time inside of this range trading around 50%. If you look at the profile, you can see that price has traded the most amount of orders, right in between 50% of this range here. So you know, you have to pick your poison here. Do you want to use this rejection block, right, which is a bearish mitigation block from the previous weekly profile? You could, right? It's definitely a valid idea. You could also be using this range here, which is also here a mitigation block, right? This wick happens to cut through 50% of the series of down close candles. You know, this is also a relevant level. Personally, I do prefer this right here, right? As this is really, this, first of all, this is from a 4-hour perspective, this is a long-term low, right? As on the right side of it, you have an intermediate term low. On the left side of it, you have an intermediate term low. Right, and from a higher time frame perspective, this is the true, right, the series of down close candles here is the true mitigation block. And as you can see, it happens to cut in between 25%, in between 50% and 25% of the 3-week look back. Okay, so personally, this is the level that I'll be using, but again, it would, you know, you could still be using here the rejection block or this series of down close candles. Okay, this is subjective to you. Okay, so we covered the highs. We have a long-term high here actually, right? Intermediate term high on the left, intermediate term high on the right. Right, so this making this a long-term high. We covered what's at 75% of the range. We have here relative equal highs that formed from a bearish order block. We saw that 50% to 25%. We have the range of here a bearish mitigation block. Right, you can see so far the market came close to trading to 50%, rejected. Overall, not even able to print bodies above 25% of it. And then at the low, right, this is mostly where my interest will be in terms of a weekly profile. We have a large rejection block. Okay, so this is I'm organizing my chart in terms of the weekly profile. Again, this level only useful to me as a drawn liquidity. This level and this level useful, very useful to me in terms of order flow. And especially this rejection block here to me will be very important right now that the market has closed pretty heavily today. Right? It tried to trade higher, then rejected at the mitigation block, and now has closed bearish. It's going to be important for me to see how the market trades inside of these levels. Does the market trade to 50% and reject, right, making a new low of week here on Tuesday and then trading higher? This can be good narrative to anticipate a classic buy. Okay, and the reason for that is not just because it were to fail at the rejection block, but because we have the higher time frame context, right, on our side, if that were to be the profile of week, right? Higher time frame context being, again, price comes from expansion to consolidation. We have a fair value gap at 25% of this range, and the market is holding this range so far. If the market were to displace this level, right, 50% here of the rejection block, then again, this where, right, we would have no more discounted levels from a 3-week look back perspective. So this is where I would start paying attention to the monthly fair value gap and the previous yearly high. To me, price displacing above 50% of this mitigation block would mean that the draw liquidity will be the premium order block here. I'd say something like this happens or something like this happens, right? Then in that case, the draw liquidity would be the order block. All right, we can look at the 3-day look back. So 3-day look back, we have here a classic sell, so we have an expansion. 2-day look back, we have here a bearish swing to Z. That's so the market at the open of Friday expanding, right, and then consolidating throughout the rest of the day. And yesterday, right, in my opinion, yesterday is a New York reversal, right? Market consolidating at the open, trading higher in New York, and rejecting. Okay, so we got an expansion to a reaccumulation to here, so far a continuation, right? Expansion, consolidation, expansion. So a turtle soup of the range, right? New York, that's what New York did here. Came back to 50% here of the dealing range and failed. Okay, so now because price has failed at 50%, again, my eyes turn here to what's located in discount, which is that large rejection block. Okay, so while we're at it, then we can put up our levels here from the 3-day look back. We have the high of the 3-day look back, obviously, right, where we have a rejection block. We then have an order block located at 75%. We have the previous daily high at 50%, right, which is an intermediate term high here. That's a characteristic of New York reversals. At 25%, the range is pretty high resistance. I'll simply be using the rejection block. Okay, so to me, very important to see how the market will trade inside this level tomorrow, especially 50%. If I'm bullish, I don't want to see any strong closures below this level. I do also want to pay attention to divergences around this level. So far, I believe that the S&P 500 has closed much weaker than Nasdaq. Okay, so say a scenario like this, right, where the S&P 500 were to make a new low while Nasdaq fails to do so, this can provide a good opportunity for an open low high close day. If at the open the market will first trade higher, right, then in my opinion this will favor a delivery for an open high low close profile or for a Z day. Okay, some kind of because I don't think it will be that easy for price to displace this rejection block here. There's been quite a lot of damage that's been done in this wick, and again we saw where it happened, right, at 50% of the weekly fair value gap. So I assume that the market won't be low resistance going through this, right? Overall, this is a balanced price range. I do think that price will stall, right? Even if it needs to trade lower first, it might trade to these levels, consolidate. Okay, so this is actually another scenario that could happen, even if today will be some kind of classic sell, but would obviously first trade higher, trade back, say maybe inside the order block or the rejection block, right, the intermediate term high, and then would fail, and you're anticipating, say, an open high low close, right, some kind of expansion profile, but New York opens in discount, right, near the range of the rejection block, then in that case, again, I would anticipate either New York to consolidate, right, and then the PM session could continue. If not, the best case scenario here would be for New York, right, to open in discount, first trade higher. Okay, it could trade higher, say somewhere, if the market starts trading higher from these levels at the open, and then were to fail, right inside here a bearish mitigation block. And maybe it will be some kind of fair value gap, some kind of order block through this range on this side of the curve. Okay, and then once that were to happen, then right, you want to try and get involved on the right side of the curve. Okay, so quick recap. We analyzed the higher time frame picture here. We know that price comes from expansion to consolidation. This week has opened inside the PD rate located at 25% of the 3-month look back. So now the question that I'm trying to answer is, will it be enough for the market to trade higher, right? As from a higher time frame perspective, that remains the bias since we come from expansion to consolidation. Will it be enough for the market to trade back to all-time highs from these levels, or will it need to trade back towards further discounted levels such as 50% of the range, where we have a monthly inefficiency, we have the previous yearly high, which is, as we saw on the monthly chart, a mitigation block, right, and then from there to trade higher? Well, one way you could be viewing, right, or anticipating that is by seeing how price is to react once it trades, if it were to trade back, right around the range of, say, 28,500, right? So we're looking at the range 50% of the weekly fair value gap. If the market displaces this level, then you can anticipate for the monthly fair value gap to be traded to. On the other hand, if today has a shakeout lower, a divergence, right, etc., and whatnot, then you can anticipate for price to start trading back higher, say towards the range of the bearish fair value gap, the bearish order block. And overall, like I said, in terms of premium arrays, I'm not necessarily using these since they come from the consolidation, but rather I'm interested in seeing if the discount order block from the previous monthly range here can become reclaimed, right, as it is now being used as a bearish mitigation block. Okay, we analyze the 3-week look back. We saw what was in the range, right, levels that are important to gauge order flow, such as the discount rejection block, such as the bearish mitigation block located in between 50 and 25%, so discount of the range. We saw that in premium of the range we got relative equal highs, right, with the previous weekly high and the high from 2 weeks ago. And we saw that these relative equal highs formed from a bearish order block located right through the quadrant. So again, this level to me is useful only as a drawn liquidity. Most importantly, what I'm interested in seeing is how the market trades around 50% of the bearish mitigation block and of the discount rejection block here. Right, the way that the market is going to treat either this one or this one is what's going to give me a bias towards a drawn liquidity. If the market breaks 50% of this, right, it has a displacement, has a favorable daily profile as it's right cutting through 50%, then in that case I can anticipate for the drawn liquidity here to be the premium order block. Vice versa for this level, if the market were to displace and have a favorable daily profile, displace 50% of the rejection block, then in that case, as we saw, we'd be targeting in terms of, well, we'd be targeting 75%, the low first here of the weekly fair value gap, and then past that, the monthly fair value gap. Okay, so these two are very important to me, the mitigation block and the rejection block. And then on the 3-day look back, we analyzed the phase of price delivery. We saw that price comes from an expansion to a consolidation to here continuing. I mean, it's not such a large day, right? You could overall consider this still as a, right, all this as an expansion to consolidation. But you know, no matter if you consider this expansion to both these days consolidation or expansion, consolidation, continuation, no matter what, I think that is pretty clear that we're anticipating to see price trade back towards discounted levels. Okay, and we saw that inside of the 3-day look back range, inside of discount, there's that rejection block, just like we have it on the 4-hour and the daily. Okay, so this is a very, very important level. We saw that here at 50% of the range, we have an intermediate term high, which is the previous daily high, right? We have here a large rejection block. Was already retested, right? 50% here, the PM lunchtime PM session, right? The expansion then came from those levels. We saw that at 75% of the range, you know, you got a lot of PD rays here. You got overall, an old wick, an old mitigation block here. This order block forms from these levels. You got here a fair value gap, a suspension block. You got here large rejection block. You got here a bearish order block. So, you know, pick your poison. Personally, I'm using the order block. Range high, we have a rejection block. Again, to me, the order block or the rejection highs, because of where we are in the range, are only useful to me as drawn liquidity. Most importantly, what I'm interested in seeing is this right here, the rejection block. Will the market trade to this level, reject, create divergence? In that case, I can anticipate for price to want to trade back to at least 50%. Okay, so I would be targeting here 50% to the high of the rejection block that created the previous daily high. Past that, right, then this is where we're looking at a low-hanging fruit objective. And if the market is to displace this level with a favorable daily profile, such as an open, high, right, low close, then again, in terms of discounted targets, we have nothing else on the 4-hour, we have nothing else on the 3-day look back. So that's when we need to look at the daily chart, or we need to look at a 3-month look back and see how price starts trading around 28,500, 28,300, 28,000. If we were to trade past that, then that's when it would be useful to put up the quadrants of here, the monthly fair value gap. Okay, I think that covers it for today. So good luck and good trading for tomorrow.